In today's video, I'm going to teach you how to put together the right asset allocation for your retirement investment portfolio. Now, when it comes to retirement investing, we have to manage two things. Short-term spending needs, we need safety, but we also need to have part of the portfolio dedicated to growth to provide financial security for the rest of your life. I'm going to do this using a case study as well as some charts that I've prepared to help you understand some crucial principles for investing as a retiree. So without any further ado, let's get right into this video. Okay, so our case study today, we're looking at Tom and Jill. They're 60 years old. They have a portfolio of about $1.5 million, and that's going to generate a sustainable retirement income of about $9,000 a month net. Now, the first step, we already are at this point where they have a retirement income plan. So really, to be able to figure out how you ought to be invested is you kind of have to get to this point. You have to build a retirement income plan, which means mapping out all of your portfolio and all of your cash flow sources like Social Security. Now, there's lots of softwares out there you can use. I don't use it, but it's actually a pretty good one that I've talked with a lot of people that anybody can use online. It's called Bolden. So if you have that, you can use that. There's other retirement income planning softwares available. I use one for advisors called Income Lab that's really robust, has a lot of features. But once you've gotten to this point of mapping out a sustainable retirement income plan, now you can look at taxes, because by looking at taxes, you know where you're pulling out money from the portfolio, from which accounts and when. I'm going to keep the conversation a little more simple today and just look at kind of the overall portfolio, even though actually they've got different types of accounts, but I'll just keep it a little more simple. So we have their retirement income plan. Let's look at their cash flows. So for the first 5 years of retirement, we need to have money invested very conservatively. Now, what that means when it gets right down to it is having safe investments like money market, short-term bonds, and high quality investment grade bonds. You can see that for the first 5 years, they have all of their income. You can see that's illustrated here in yellow. It's all coming out of the portfolio. So we can map this out and say, okay, how much money? So the first step is to say how much money is coming out of the portfolio within the first 5 years. So for them, they start out by taking out about $111,000 from the portfolio. Then it goes up to 114, 117, 122. And so we map that out. We look at all of their cash flows for 5 years. For this scenario, it's about $580,000. So we look at the overall portfolio, $1.5 million. We need to take of that $580,000 and invest it very conservatively. Now, the reason why we do that is because if you're invested 100% aggressively, like in stocks, then when the market goes down, not if, but when it does, because it happens all the time, as the market goes down, you are forced to sell more shares in order to generate the same level of monthly income. And so by having a war chest, 5 whole years of spending just set aside in something conservative that maybe is either going to not move at all, or sometimes when the market goes down, bonds could even go up in value, which is positive, or they'll go down just a little bit. But by having that money set aside, the market has a chance it'll go down, and then as it comes back up, assuming you have a well-diversified portfolio, historically that's what we've seen, it comes back up, after a couple of years. And so, you'll be able to maintain your same level of spending or adjust it very slightly, and giving your portfolio the rest of it time to recover. Now, you might ask, okay, so if I start out with about, $580,000 in cash and bonds, like for this scenario, the first 5 years, does that asset allocation change over time? And the answer is yes, because for the next 5 years, years 6 through 10 in this case, you can see they're going to have a couple of years where they're still pulling out about $10,000 a month from the portfolio. But then once Social Security kicks in, it cuts about in half to where now you can see that between both their Social Security benefits, now their portfolio withdrawals are about $5,300 a month. So for the second 5 years, instead of needing about $580,000 in cash and bonds, these guys only need about $420,000 in cash and bonds. So basically, if I want to break this down to an asset allocation viewpoint, for the first 5 years, they're going to have about a 60-40 portfolio. And for the second 5 years, it's going to actually get a little more aggressive to about a 70-30 portfolio. Now, the years 10 through 15 or 11 through 15, after they've already been in retirement for 10 years, now their portfolio is going to go up even more, because now they have Social Security for those entire 5 years. So now, for years 11 through 15, they can actually go up because they're only going to need about $62,000 a year from the portfolio, which means $320,000 in cash and bonds for an overall asset allocation of about 80-20, 80% stocks and 20% in cash and bonds. And this is a very, straightforward rubric you can use to give yourself a really good chance of being able to maintain your cash flow from your portfolio and maintain growth in your portfolio over time. It's a little counterintuitive. Usually you would think, okay, as I get older, I need to be invested more conservatively. And I'd say generally that, that is true. But what that fails to consider is that as you get later on in retirement and you have other income sources like Social Security that kick in, those income sources kind of make up part of that conservative allocation because they are taking the place of that short-term cash flow. So you don't need as much of your portfolio invested conservatively because your guaranteed income like Social Security is taking care of part of that. So now that you have a general understanding of that, how to build a general asset allocation for investments, I want to go over some really important principles that I think will really help you build a better portfolio. And I have to say that all of this is not investment advice. All disclaimers up front. These are principles that historically have worked, but there's no guarantee for the future. So, obviously you need to be well informed and try and do your best to make good decisions. But I think these are some good principles to get you in the right direction. I'm going to show some charts that I've prepared. So the first principle of retirement investing is the principle of inflation. Now, I think you're probably well aware of the way this works. Inflation essentially is that over time, your ability to buy stuff with your money goes down. Your money becomes worth less over time. And that's the whole purpose of investing. The reason we have to invest is as you own capital assets that can benefit from inflation, that can grow over time in excess of inflation. This is what provides financial security over the course of your retirement. The next principle is investing based on time frame. Now, when you own a diversified portfolio of stocks, I'll talk more about diversification here in a minute, but at first, what this chart here is showing us is the average returns of owning the S&P 500 over different time frames back to 1950. So you can see that on average, just owning the S&P 500, the average gain is about 0.03%, per day. Some days are down, some days are up, but on average, it's positive, but it's a very small amount. Now, as we go to longer periods of time, a week, a month, 3 months, 6 months, 1 year, 5 years, you can see there's a direct relationship here. The longer you own a diversified portfolio of good quality companies, good quality stocks, your chances and the amount of your gain go up over time. And that's the whole reason of locking in the first 5 years of cash flows when your chances of having a gain in the stock market are lower. And so you're protected to be able to have a portfolio of money to draw from to allow your equities to grow over time, because it's really those longer time frames that give you the best chance to compound your money over time. Now, I love this chart. We've talked about the average gain over different time frames, and as you go along further into the future, the amount of gain is larger. But let's talk about the probabilities historically, the likelihood of having a gain or having a loss over different time frames. And there's a relationship here. The longer you own your investments, the more likely you are to have a gain in your portfolio. So going back from 1950 to the present, on average, your portfolio will be worth more if you own it for a day 51% of the time, which means 49% of the time you'll end up having a loss. As your holding period increases, your chances of having growth go up over time. So over a week, you've got about a 57% chance of having a gain. Over a month, it's about a 62% chance of having a gain. Over 3 months, 66%. Now let's just go clear out here to the future. Over 5 years, you have about an 84% chance of your money going up versus having a loss. Over a 10-year period of time and over a 20-year period of time, there's never been a 20-year period of time in the U.S. stock market where you would have actually, invested and had a loss after 20 years. You would have had a gain. So you can see that really what we're trying to do is put ourselves in the most favorable position, stacking the odds in our favor. We're going to own the right asset that has the best chance of giving us a gain, and the likelihood of having a gain is going to be high as well. So longer the time period, better chance to have a gain, and a better chance of having that gain be substantial above inflation. So let's talk about when there are losses and gains in the stock market. So again, going back to 1950, most years the stock market's up, and over time, on average, depending on the time frame you're looking at, the U.S. stock market, if we look at the S&P 500, has been up by about 8 or 9% per year on average. But most years, you don't get this nice 9% rate of return per year. It's not like that. When there's an up year, usually it's about 17.8% on average. And when there's a down year, typically it's about 11.8% down. Those returns over time are very bumpy, right? I mean, like you'll have a great year and then like kind of a cruddy year, maybe an awesome year, maybe a couple of great years back to back, and then a really bad year. And so if you're investing over time and you're not getting this like steady 9% per year, that's just not the way that the stock market works. It's very choppy. It's very up and down. So looking at the last chart, somebody might ask, okay, so how about we just have our money invested when the market's going up, and when it goes down, we don't invest? Well, you're right. That would be awesome. The problem with that is that usually when there is a bad year or even a bad day or two in the stock market or a bad month, the worst days in the stock market are almost always followed by the best days. So it's like we've seen this a lot over the last few years with with COVID-19, as well as with even just April 2025, where the stock market drops significantly, but then it rebounds very quickly. And so if you're trying to get out of the market, trying to time it and get out when it's going down, problem is that you have you're more likely than not, like you might miss a couple bad days, but you also might miss the days when it goes right back up. And what this chart here is showing us is the difference of being fully invested, regardless of all riding the ups and downs, versus what happens if you miss the best days throughout the year. So if you're just fully invested from 1950 through 2025, you would have had an average annual rate of return of 8.3%. Now, what if you just missed the one best day per year? So like all throughout the year, let's say you're trying to get in and out of the market, trying to miss the worst day. Well, if you're trying to miss the worst day, you're probably going to also miss the very best day. And just by missing the one best day each year, your average rate of return would have dropped from 8%, over 8% per year, down to 4.8% per year. Pretty drastic, almost cutting your return in half. Now, if you'd missed the 5 best days in any given year, your return would have dropped to negative 4.3%, and missing just the 10 best days each year, your return would have dropped to an average of negative 12% per year. So I can't stress this point enough, is that you have to just stay invested and ride through the ups and downs, because trying to miss the worst days, you're probably going to miss the best days too. And if you miss those best days, even just a couple of them, it'll have a huge negative impact on your overall returns as an investor. Okay, so this leads us to talking about one of the ways that we can manage risk within our portfolio as a retiree, and that is through having a good asset allocation, being diversified, not just being invested in 100% stocks. So this chart I think is really helpful. This is just looking back to 1990, and what we're doing is we're looking at, with a different mix of stocks and bonds, how many 10% drops would you have had over from 1990 to 2025, so 35 years, right? With the different mixes of stocks versus bonds. So if you had been invested in 100% stocks, there would have been 14 times that your portfolio would have dropped by more than 10%. Now, as you add in some bonds, go from 100% to 90% stocks and 10% bonds, those 10% drops, you would have only had 12. Add a little bit more stocks, add a little bit more bonds, 20%. Now you would have just had 11 times that you would have had a drop of more than 10%. As you go along, you can see that as you add bonds to the portfolio, you're reducing pretty significantly the amount of significant negative drops in your portfolio. So this is just like a very easy way to understand how to reduce those major drawdowns, is by having some bonds in your portfolio. And then again, how much should I have? Come back to cash flow. How much are you going to pull out of your portfolio over the next 5 years? And that's how much you're setting aside in cash and bonds in order to protect your stock portfolio from having to be drawn down in a bad market. Now, for the final slide, I want to expand on the idea of diversification, because up to this point, we've talked about investing in a diversified portfolio of US stocks. You notice I haven't even talked about just owning a couple of stocks. When you own a couple of stocks, you're really increasing your risk of, frankly, either having huge gains, but also having catastrophic losses that you can't come back from. When you're investing in retirement, it's about putting the odds in your favor. And so the best way to put the odds in your favor is by staying broadly diversified and not just betting on a couple of companies. Now, we've talked about owning bonds and cash and where those fit into the portfolio for your spending needs for the next 5 years of spending. But what other investments are available to you that can enhance your diversification, that can give you a better chance, historically, right? That would have given you a better chance to have good inflation-adjusted returns over time. So what this chart is showing us is we're looking at different investment categories or asset classes and their returns year to date in 2025. To give you an idea of what are some of the other investment opportunities that are available, things that you could consider adding to your investment mix. So as part of your growth growth or stock allocation. Let's look at some of these options. So here we have international stocks. We have emerging market stocks. Now, international stocks, generally when you're looking at like an ETF or a mutual fund that's invested in international stocks, usually what this means, now you have to obviously look at the fine print for whatever investment you're using, but this usually means companies based out of Western Europe, based out of Canada, based out of Japan. Now, emerging market stocks, these are usually investing in companies based out of the emerging world. So places like Mexico and Brazil and China and India, countries like that, Eastern Europe, like Poland. Then we have, of course, U.S. large company stocks. This is like investing in the S&P 500. Then we have TIPS, Treasury Inflation Protected Securities. We have commodities. This would be like investing in a fund that owns maybe gold and silver, different precious metals, as well as other commodities like oil or wheat, soybeans, that type of thing. REITs, this is investing in funds that own commercial real estate. And you can actually have REITs that are based out of just the United States as well as internationally. Then you've got smaller U.S. Stocks like mid-cap stocks and even smaller small-cap U.S. stocks. And then, of course, bonds and cash. Now, you can see the returns year to date. Pretty interesting here. We haven't seen this in a long time, but international stocks this year have actually done very well. Now, does that mean they're going to do great next year? No. I have no idea what's going to happen next year. But that's really the whole point of diversification, is that you don't know what's going to happen in the future. So you broadly diversify. If we knew what companies were going to do awesome, we would just invest in those, right? Now, it's really easy after the fact, in hindsight, to say, oh, wow, that company did awesome, or that investment category was the very best one. But that doesn't mean that's what will happen going forward. The whole idea of diversification is an acceptance that you don't know what's going to happen in the future. And so you spread your bets around. And these are different investment categories that historically will often zig and zag at different times. And when one is going up, maybe one's going down, or one's going up and the other's going up a lot more. And so if you own all of them, or you own, a few of these, that gives you a good chance of when there's growth happening in the global economy, you can participate in that. And all of your money is invested in just one category, well then you might miss out when there's growth in other parts of the global investment universe. So now that we've gone over the principles of putting together the right asset allocation for your retirement portfolio, I think you're in a better place to really understand how you should position your investments based off of how much money you're spending and when you're going to spend the money. And you're also more aware of the way that the stock market has behaved over time, different investment opportunities that are available to you to help you make maybe more informed investment decisions as a retiree. If you'd like some help looking at your retirement portfolio, figuring out what might make sense for your situation, I'd be happy to sit down with you one-on-one to go through your situation. You can do that by clicking the link in the description and scheduling a free consultation with me. So until next time, I hope you have a great week, and I will see you in the next video.